a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about gold ETFs. And gold has surged 20% this year, making it one of the best performing major asset classes this year. And that surge is mainly because investors are searching for safe assets amid this coronavirus related economic uncertainty, and also because central banks and governments around the world have launched unprecedented monetary and fiscal stimulus, and that has brought interest rates all over the world to record low levels. And very low interest rates benefit gold because the opportunity cost of owning gold goes down when interest rates are so low. And because of the surge in gold prices, gold ETFs had record inflows this year. They gathered about 40 billion globally, which is much more than the previous annual record of 23 billion from 2016. And then gold is also getting a boost from geopolitical uncertainty. You know that we have US presidential election and there is rising geopolitical conflict, trade tensions between US and China, and then border tensions between India and China, and there are renewed tensions between North and South Korea. So all these are benefiting gold. And also, when interest rates are so low and there is so much money in the system, inflation may go up in the coming months, though it is, as of now, it is very low. So, gold protects against inflation too. So, those are the reasons why gold has gone up this year and may continue to go up. Now, let's take a look at the longer term investment case for gold in the portfolio. So, as I mentioned, the gold acts as an inflation hedge, and over the long term, over very long term, it has proven to be a good inflation hedge. So, if inflation goes up due to unprecedented monetary and fiscal stimulus, then gold may continue to benefit. Then the second reason is that central banks around the world, they have been buying a lot of gold for their reserves. So that also benefits gold. And then there is rising demand from India and China. Consumers in these two emerging countries, they have been buying a lot of gold because they treat gold as a store of value. In fact, consumers in India and China account for almost 40% of global gold consumption. Now, that consumption has gone down this year because of the coronavirus crisis, but it may pick up once demand picks up in these countries and the longer term trend remains favorable. And last but not the least, the one which I like a lot, that gold has low correlation with most other asset classes. And that is why it acts as a portfolio diversifier. So I believe that gold should be a small part of any diversified portfolio, about 5 to 7%, in any portfolio makes a lot of sense. Now, let's take a look at gold ETFs, and I'll be highlighting three gold ETFs. The first one that I wanted to highlight is by State Street. It is the first and most popular gold ETF, and it is almost all investors know about it. It is the Spider Gold Trust, ticker symbol GLD. It has over 70 billion in assets, very liquid, but it charges 40 basis points, so it is slightly expensive. Now, this ETF each share represents about 1/10 of an ounce of gold. So it is very good for traders who want to trade in and out of gold for short-term trade, but it is not the right ETF for buy and hold investors because of its high expense ratio. So in fact, last year, State Street launched a cheaper version of GLD. Now let's take a look at that ETF. It is the Spider Gold Mini Shares ETF, ticker symbol GLDM. Now, there are two differences between GLD and GLDM. GLDM charges just 18 basis points, so making it one of the cheapest ETFs. And then each share of GLDM represents about 1/100th of an ounce of gold. So this appeals more to investors who want to place smaller orders at a time. Now, the third one, which I wanted to highlight, is by Aberdeen. It is Physical Gold Shares ETF, ticker symbol SGOL. It is the cheapest gold ETF with an expense ratio of just 17 basis points. And this also has over 2.3 billion in assets under management. And in fact, there is not much difference between 17 and 18 basis points. So either GLDM or SGOL is pretty good for long-term buy and hold investors. Now let's take a look at the performance. So on this slide, I have the comparative performance versus the S&P 500 index year to date. And as you can see, gold is up about 20%, whereas the S&P 500 is barely in the green, almost flat for the year. Then on the last slide, I take a look at the comparative performance over the past year, and you will see that gold is up more than 26%, whereas the S&P 500 index is up about 10% year to date. And in full disclosure, I own GLDM in the ETF investor portfolio that I manage. Thanks for watching, and make sure to check out zacks.com/promo for an interesting offer, and I'll see you next week.